Thank you, and also a very warm welcome from my side today, ladies and gentlemen, whether you're here or on the webcast. I thank you very much for being here today with us, spending time with us. I'd like to start briefly by introducing my colleagues, who will also be on the speakers podium today. So, starting with our ad interim CFO, Nicola Rotondo. Get up. They can't see you, you're not that tall. Yuri Durinks, President of PCT. Dionys van de Ven, President of IXS. And Michael Berger, President of IXM. So they will join me on the podium later on, and especially as Uli mentioned before, you'll hear quite a lot about Synertia from Yuri later on. Now, it seems to be the case, just from experience, that it is darkest before the dawn. So 2023 has been a very difficult year for us, not only for us, but the entire industry. Now, not to divert from this today, we focus today on the long-term outlook, and indeed, we see a very wide and long runway ahead. So growth opportunities are ahead. I will speak about 4 things today, filling out 3/4 of an hour. The agenda covers Comet at a glance. So for all of you here who are not too familiar with Comet, I'll give you a nutshell introduction to Comet, followed by our market trends and developments, then a glance at our strategy, and then I will close with some remarks on the outlook and our targets. So let's get started for real. Now, Comet in a nutshell is a group highly focused on 2 technologies: plasma control, or RF power, and X-ray technology, X-ray inspection. And we're fully committed to enable most and foremost the semiconductor industry. We operate and go to market with 3 divisions, so PCT, plasma control, IXS, X-ray systems, and IXM, X-ray modules. The 3 divisions serve 4 principal end markets, however, with a very clear focus, and I will repeat that on and on during the day, on the semiconductor and electronics industry. PCT is a leader in RF power solutions with customers primarily in the front end, so the beginning of the semiconductor industry. IXS is a leader for high-end X-ray and CT system solutions, enabling, in principle, non-destructive testing in various industries, focused semiconductor, coming from aerospace, automotive, and also kind of all sorts of lab applications. And so it is from R&D to production, right? And IXM is a leader for high-end X-ray sources for non-destructive testing of parts in industries such as, again, semiconductors, electronics, automotive, aerospace, as well as security inspection. Important, all 3 divisions have their main focus on the semiconductor industry, which is by far the group's main market in terms of revenue today, but also in the future. So we cover, with our 3 divisions, the entire value chain for the semi-industry and are positioned very clearly for growth. PCT, as mentioned before, in the front end, where our key strategic move is forward integration, moving up the vertical, starting from the vacuum capacitor to the matchbox, and now with Synertia, the full RF subassembly. Both X-ray divisions focus on PCBA inspection, so printed circuit boards in the back end of the industry, and in the middle of the whole value chain, we address the emerging opportunities of advanced packaging. I'll talk a little bit more about that later on. So with IXS on system level, with IXM on modules level, both independently as well as collaboratively. This presence along the entire value chain enables Comet to address some of the same customers with different technologies. benefiting from our good reputation that has been built up over the past 75 years. While both X-ray divisions continue to increase the semiconductor share of revenue, they continue obviously to profit from the legacy markets such as automotive, aerospace, and security. This will not change, and especially the automotive space and the growth of electric vehicles is a market where all divisions have a very interesting stake. So firstly, the semiconductor content is rapidly increasing in such cars to the benefit of PCT. Secondly, fail-safe electronics is bringing business to both X-ray divisions. And thirdly, batteries are offering great business opportunities as well to the X-ray divisions. Now, you may ask, but why do our customers have a steadily increasing demand for our products? Now, for decades, chips scaled according to Moore's Law. You'll hear a lot about Moore's Law today. And Moore's Law is just about linearly, on the surface, shrinking devices and interconnects. This approach is, however, increasingly, as you get smaller and smaller and smaller, facing a lot of challenges. And so over the past decade, new topologies and architectures to continue Moore's scaling law into the third dimension have been created, improving performance and power consumption per unit area of silicon, as well as reducing costs per device. Now, this integrated scaling approach to performance, power, area, as well as cost is the current paradigm and has resulted in microprocessors and systems on chip with vastly superior performance, but all requiring more and more plasma, which is extremely good for us. In addition, this approach also requires new systems for quality testing to enhance product and process yields. This is the point where really superb opportunities arise, open up for both X-ray divisions. And the reason why we are also extremely happy to have all three divisions under one roof that target the same high-growth industry. Now, some figures. Today, Comet generates around 65% of net sales in the division PCT, followed by IXS with 22% and IXM with 13%. So round about 2/3 from PCT and 1/3 from the X-ray divisions. All divisions command strong market positions. Plasma control technologies is a clear number one with vacuum capacitors and impedance matching networks, or in short, matchboxes. And in a vastly more fragmented market, IXS is among the top three in all markets served, while IXM occupies an undisputed position as number one in metal ceramic X-ray tubes. To be close to our customers is very important in our industry. Therefore, we have a rather large global presence for the size of the company and generate most of our sales outside of Switzerland, even outside Europe, despite our headquarters in Switzerland and strong European footprint. Now, the most important markets for the semiconductor and electronics industry are Asia and the US, with about 50 and 38% of group sales, respectively. Now, the large contribution from Asia is thereby not only due to Asian customers, but also to Western customers who have expanded their local presence in recent years. So in a nutshell, this is the Comet Group as we stand here today. So let's take a look at our markets, trends, and developments with a focus on semiconductors only. Now, why is Comet benefiting from today's trends in technology? Now, the current changes in technology require, as I mentioned before, more plasma processing and more X-ray inspection than ever before. 3D and nano-semi structures are requiring better and more plasma processing, be it on the etch side or on the deposition side. Heterogeneous integration or advanced packaging, or in short AP, sets limitations to conventional inspection requiring X-ray CT to develop and control both processes and products. So basically, as you go 3D, go out of the plane, there are limitations to do optical inspection. You can't see inside, so what do? Well, use CT, use X-ray. And then finally, the electrification of our society, as exemplified with EVs, increases the need for fail-safe electronics and thus the demand for X-ray inspection. So in simple terms, Comet is sort of in a sweet spot with its technologies for enabling the digitization and electrification of our society. Now, digitization of society encompasses the widespread adoption of digital technologies and data-driven practices affecting how businesses operate, how we as people live and interact with technology, or how governments and organizations provide services. Many applications, from AI to the Internet of Things, have one thing in common, and that is an outrageous appetite and need for silicon, resulting in a projected growth in semiconductor revenues from $574 billion in 2022 to the much talked about and fabulous $1 trillion in 2030. Now, despite the correction, despite the dip that we are going through in 2023. As part of this growth story from humble beginnings in medical starting in 1948, we expect to grow with our customers our semi-related net sales to more than 80% of total group sales in the next 3 to 5 years. Obviously, the lion's share of this will come from PCT. However, both X-ray divisions will significantly increase their sales into the semi market. Now, why are we so confident about this? Well, confidence comes, among other things, from the number of fabs, or the factories where they churn out all the semiconductors that are under construction. Now, between 22 and 24, 82 new fabs will have been built and will come online, or are already online, kind of underlining, putting an exclamation sign to the industry's confidence in forecasts for strong demand growth for microchips. Now, further growth will also continue till 2030 with a further estimated 100 new fabs that will be built. And with AI becoming the ultimate productivity tool for probably generations to come, this may even be conservative. Now, in the short term, however, the ongoing market correction has turned the semi-industry pretty much on its head, and this mentioned build-out has been slowed, impacting the order intake throughout the value chain, as we have seen this year. Now, clearly, with more favorable market conditions and improved balance of supply and demand for semiconductors, in the not-too-distant future, a significant increase in incoming orders for equipment manufacturers, and therefore also Comet, is anticipated. Now, for investments into wafer manufacturing equipment, so our market, this means for 23 a significant decline, expected to be around 12% and even higher if lithography is excluded. Return to growth is expected in 24 as the increasing number of fabs coming online in 24, and then also the ones that have been slowed and postponed in 25 will have to be equipped, among other things, with products from Comet. Now, while the estimates vary widely, market observers agree that wafer fab equipment spend will increase significantly in the coming years. And an annual growth rate of 9% is forecast for the period from 23 to 27. So the foundation for future growth for all divisions, but especially for PCT products, has therefore been laid. So Really good business ahead, and that is the reason why we are very confident. Also, our X-ray divisions have an equally good foundation with their focus on the semi market and especially advanced packaging of silicon devices. Advanced packaging offers several advantages over traditional packaging methods, especially as semiconductor devices become more complex and demand higher performance. Between 22 and 27, the AP market is forecast to grow by around 11% annually, so even faster than the wafer fab equipment market. Growth is driven by the need for further miniaturization, so think about computing on the edge, has to be very, very small, and also improved performance and cost efficiency. These needs make advanced packaging a major enabler for further performance gains in high-performance computing, artificial intelligence, or in general, just smart devices. Market intelligence says that AP revenue will thereby surpass revenues from traditional packaging technologies in the next 5 years. What makes AP or advanced packaging highly attractive for X-ray inspection? Well, optical inspection, as I mentioned before, has been a very powerful tool over the past many decades and used for quality assurance. And this method, as mentioned, is sufficiently fast and powerful. However, it does not provide three-dimensional insights, and as advanced packaging sort of by definition is using the third dimension, you stack those elements, there is no way that you can see inside in between the different layers that you stack. So X-ray inspection will become a complementary method that provides actionable information for IC process development and process monitoring. Not to forget, one goal of our customers is to speed up time to market and increase yield. And inspection plays a very crucial role, especially within advanced packages, where there is more complexity and inspections are very much more challenging. Now, given PCT's existing exposure to many of the market leaders in advanced packaging, such as TSMC or Samsung or Intel, access to these customers through previous contacts by PCT is vastly facilitated, and therefore, again, it is God sent that we have all the three divisions under one roof. Now, let me not leave out developments causing uncertainty in our markets. Now, with the ongoing trade conflict between the US and China, but also armed conflicts, a rethinking has taken place in politics. Semiconductors are being considered as highly strategic, rightly so, and therefore governments in the US, China, the EU, and other countries have launched regulations and support programs to promote regional development of semiconductor production and expertise. What can result from this clearly is the creation of overcapacity, something that is not very much liked and usually is the start of a downturn cycle, or in general, a misallocation of resources. In addition, new regulations are constantly being created or modified, so this development creates clearly uncertainties in the entire semi ecosystem, probably one of the most globalized industries of all. For us, as well as for our suppliers and customers and their customers, this means to constantly think in scenarios and to prepare for possible shifts in the global semiconductor market. So far, we have coped very well with the effects of the different trade restrictions. It came as a shock October last year and caused quite a phase of confusion and also lowered revenues towards the end of last year. Of course, despite the fact that we have been coping well, we must keep an eye on the developments and deal with them proactively. However, despite all the uncertainties, it should be noted that semiconductor production is in a structural growth phase. Investments around the globe are increasing as the US and China, but also Europe, are making funding available for domestic semiconductor production, design and research, initiatives to localize the chip value chain, which is considered as so strategic. So accordingly, we see some short-term disruptions, but expect the opportunities that come from that in our sector to outweigh the challenges for Comet. So to summarize, Comet is well positioned in markets with a highly attractive growth profile. Our served available market, so on the right side, is expected to grow by 83% from 22 to 26, compared with the total available markets growth on the left side of 35%. Now, a growing market penetration of Synertia and the focus of IXS and IXM on the semiconductor market are opening new revenue streams for Comet. These obviously are the ingredients of our success story. So, with all that said, what's the strategy that we pursue to tap into this huge potential offered by our target markets? Now, before I get into this, what is our goal? What do we want to achieve? Now, simply put, we want to become the undisputed market leaders, addressing our full potential in all verticals that we serve. So for PCT, the full plasma excitation and control chain. For IXS, CT systems, the best ones you can have, in order to address this emerging opportunity of advanced packaging inspection. And for IXM, the full X-ray source chain from X-ray tubes to modules with a special focus on semiconductors. So to get into the strategy, let's back up to 2019. Now, after a strategic review in 2019, we decided to pivot and focus Comet on the semiconductor industry. An industry, again, offering much higher growth rates and profitability than our traditional markets like aerospace and automotive. Well, we defined measures driving us forward toward our medium-term goals for 2025 and bundled them into our Boost strategy program. Now, with today's Capital Market Day, we can proudly point to many achievements in the program, amongst others, the launch last year of the RF power platform Synertia, or the successful divestment of the loss-making e-beam division, just to name a few. We have achieved a large part of our goals in a market environment that was very challenging during the last years, especially also this year. Now, based on these achievements, taking into account the ongoing market correction, based on our expectations for the 2023 financial year, and lastly, our midterm plans and the market trends that I just talked about, we communicated today our adjusted midterm targets. Now, the new targets have a time horizon until the peak of the next semi-cycle, which is estimated to be around 2027. But because the overall economic development and its impact on our industry is rather unpredictable, we refrain from giving a precise year for the next peak of the cycle. We are, however, very, very confident to achieve at the next peak net sales of 800 to 900 million Swiss francs at an EBITDA margin of 25 to 30% and a return on capital employed of 30 to 35%. Now, this reflects a slight increase of the midpoint of sales, EBITDA margin, and ROCE compared to our previous midterm targets. So, the targets are set, but how will we get there? Now, first and foremost, we reaffirm our strategy and focus on three main elements in the implementation. These are growth, efficiency, and culture. To accelerate and achieve aggressive growth going forward, we further expand our product portfolio with market-leading products to win our corresponding verticals in all three divisions. Or in other words, we very much invest into R&D and customer intimacy so that the R&D dollars are well invested. Not less important are efficiency gains at all levels of the organization with special attention on our customer focus. Nothing worse than spending a lot of money in R&D for products that customers don't ask for. So how do you know what customers need? You have to be very, very close to them. And that means you have to be out there in the world where the customers sit. And finally, we further promote a value-oriented corporate culture that reflects our three values of challenge and empower, customer focus, and trustful collaboration. Now, let me focus at individual elements of our strategy, starting with growth. Our growth strategy is, as I mentioned, aimed at expanding our share of wallet in the semiconductor industry with new leading products. In PCT, we focus on forward integration with Synertia and the Generation 3 match. We are driving market penetration with the major players in the industry, but also with regional champions in other areas, such as in Asia. Another dimension is, and that is a very important strategic move for us, is to reduce dependencies by broadening our customer base, regional reach, as well as market segments served. Specifically, we want to reduce our dependency on the memory market by gaining a higher share in the logic market. We want to become more balanced and thus perform much better in a downturn. And there will be future downturns again. The two X-ray divisions have common goals: expand the product portfolio for the semiconductor industry, penetrate the market with these products, while on the other hand, serving opportunistically the traditional market, so aerospace, automotive, as well as security for IXM. For IXS, it is very important to focus on more profitable growth than in the past, and the semi market allows for this, especially advanced packaging, where the value add of X-ray inspection is much, much, much higher than, for instance, for castings in the car industry. For IXM, forward integration is key into the semiconductor chain and will be achieved with products offering better resolutions for the very demanding requirements of the semi industry. So the top priority for the entire group is growth in the semi market with a technologically leading portfolio close to the customer. Now, diving deeper into the critical success factors for growth, the central driver for the group has been the launch of PCT's Synertia platform, entering the market for high-frequency generators, a market worth approximately $1 billion at this point. Together with our market-leading positions in vacuum capacitors and matchboxes, Comet has become the only company in the industry that can deliver out of one hand in-house developed and manufactured all three components that form an RF subassembly. Now, for our customers, this means that they can pretty much source all components for the generation and control of high-frequency power out of one hand from a single source. In other words, customers can rely on RF subsystems with perfectly tuned components. You will hear a lot more in a bit in Yuri's account on the PCT division. Now, while Synertia is a very important growth driver going forward, we should not forget the matchbox business, which is today the backbone basically of PCT, but to a large extent also Comet, and truly a stepping stone for PCT's forward integration strategy. Now, with a very dynamic growth forecast some years ago, we made the decision around 2019 to move our high-volume matchbox production from San Jose, California, into a leased production space in Penang, Malaysia. This allowed PCT to serve more efficiently its customers while benefiting from best cost manufacturing in Malaysia. The initial site launched, actually, its production in 2020, and after reaching full capacity utilization at the end of 22, capacity was doubled by leasing yet another floor in the building where we are. Now, with the good experience made, we recently decided to plan a further expansion in Penang to meet the projected growth in demand over the next few years. Now, we recently acquired a plot of land in Penang and entered the planning phase for our own new building. We are thereby not only examining further expansion for the assembly of matchboxes, but also a second site to produce vacant capacitors as a business continuity plan. Very important, in addition, looking forward and towards 2030, we are planning Penang to be our main hub in Asia, a location for business activities and shared services for all three divisions. Now, growth is one element of the Comet investment plan. Another is efficiency and profitability. And 2023 has shown we are not yet able to maintain profitability at an acceptable level in a downturn. Strengthening Penang and expanding in best cost regions is one, but not the only way to transform Comet into a more resilient, better performing, and scalable organization. In 2023, various measures to improve our efficiency and profitability were taken, probably too late. So besides expanding Penang, we closed one site in the US and consolidated 4 locations in San Jose into one to improve our structural costs. Workforce adaptations were implemented to adapt for the lower demand, as well as further lean activities were both initiated and implemented. 2023 has also shown that additional efforts will have to be taken to improve our resiliency, such as what I mentioned before, expanding our share in the logic market or streamlining our operational model and further pushing the digital transformation of the company. All these measures obviously require respect for the most valuable asset, our people. Attracting, retaining, and managing talent is as central to Comet's success as all the technical aspects of which you will certainly hear much more later on. We must therefore not only digitize the company, but create a digital work culture, create and nurture our own talent pool, and further foster a learning culture to keep up to date with the latest knowledge. So our Boost strategy framework focuses on growth, efficiency, and culture, but we want to do this in a responsible and sustainable manner. Therefore, a final element of our strategy is sustainability. The targets we have defined in the short to medium term, and they deal primarily with the use of electricity from renewable sources. By 2025, we want to achieve 80% electricity from renewables, and by 2030, 100%. These targets are just the first steps on the way to a net zero world by 2050 at the latest, but preferably much earlier. Now, with the eco-design initiative, so creating products that consume less power, and the planned commitment to the Science Based Targets initiative, we will implement tools that will help us to define and implement measures to achieve our climate-related goals. All in all, we see ourselves well on track to making sustainability an integral part of our business to tackle the large challenges of net zero ahead of us. Although we focus and talk very much about climate and climate targets in our sustainability program, there are other aspects of ESG, and they are not left out. We believe we are already rather well positioned in the social as well as the governance dimension, having launched various programs in the last few years. And thereby, let me especially point out our focus on occupational health and safety, which are firmly anchored in the organization. So in summary, I can say that we are continuing to implement the focus strategy defined in 2019 with all our strength, and have already numerous successes and great results. We believe we are on the right track, and we understand that adjustments must and will be further made to become stronger, more resilient, and also more successful in every possible market environment, also downturns. Now, this brings me to the outlook and our targets. Now, market indicators, and we live and die by market indicators in many ways, suggest that the semiconductor market has recently bottomed out and is resuming its growth path, although for now, currently, at a very modest pace. As shown in the graph, inventories, in this example, NAND memory, have been reduced along the entire value chain, and as a result, demand for semiconductor devices has slightly risen again on a month-to-month basis. Another sign is the forecast on the supply and oversupply of NAND devices in H1 24, which in previous cycles has proven to be a good indicator of a turnaround in the market, and therefore also for investments in new equipment, which is where the incoming orders come to us. Forecasts assume that NAND components will change from oversupply to undersupply in the first half of next year, and for DRAM chips, or the other sort of memory, a reversal is expected 1 or 2 quarters earlier, which means that our business will certainly improve over the course of 24. So with all said so far this morning, we firmly believe in our growth story. We published our forecast for 2023 in the Q3 trading update a few weeks ago. Now, given the unexpected strength and duration of the ongoing correction, 2023 is a transitional year. The medium-term targets for 2025, communicated in 2019, are being adjusted, as I mentioned earlier today, slightly upwards and postponed. At the peak of the next semi-cycle, again, estimated to be around 2027, we expect net sales of 800 to 900 million Swiss francs, an EBITDA of 25 to 30%, and a ROCE of 30 to 35%. Again, due to all the macroeconomic uncertainties, we've refrained from indicating when the peak exactly is going to be. 2027 may be a good bet. Now, beyond this time horizon, we want to continue our growth strategy and develop Comet into a company that will generate net sales of over 1 billion Swiss francs before the end of this decade. The instruments, the organization are in place, and the implementation of the existing strategy with additional measures is key to achieving this goal, and we are working on that. So, with this, I will close my part of the presentation, or my part of this morning, and hand over to my CFO, Nicola Rotondo. Thank you very much for your patience for my long presentation, and I believe we will take Q&A later on. Thank you. Nicola, please. I'm gone.
So, good morning to all also from my side. Happy to be here and to guide you through the financials. But before that, let me share some personal considerations. I started at Comet in 2010, so just a couple of years later than you, Stefan. And since then, actually, we have seen many things. Most of them went well, some of them did not. However, if you look at it from a long-term perspective, we can say that the evolution was quite impressive when it comes to sales, profit, returns, and share price development. Now, does this make us happy? First reaction would be yes, of course. Second reaction is yes, but. And what I mean with that is that we have not yet found the right setup to manage those recurring semi-downturns. And so that means that besides R&D, business development, market penetration, we want to further deepen operational excellence to become more robust and more resilient to manage those recurring downturns. So, having said that, let's go into the financials. So Stefan just talked about those targets. I'm not going to repeat them word by word, but basically what this shows is, so on one hand we have adjusted them a bit upwards, and it shows our commitment still to the strategic goals that we did communicate back in 2019. And what is important for me to say, to repeat what Stefan said, basically, we want to reach those targets at the peak of the next cycle. So we do not stick to a specific year. And basically here, based on the underlying assumptions that you see on the chart. So this is our commitment at the end of, at the peak of the cycle. Now with that, let's go and see the making of those targets. Now in this chart, you can see nicely the evolution of our top line since the last 10 years. And from 2012 to 2017, you see that we increased our share in semi. That happened basically by PCT, mainly going up the value chain, so from capacitor into the matchbox business, and that was the main driver for that steep increase that you see in that period. After that, between 2017 and 2022, we further increased that share, and that was driven by the strategy focus on semi that we did announce back in 2019. And so since then, also for IXM and IXS, those markets became more and more relevant. What's next to come? PCT, of course, they will continue to grow according to market trends. And in addition, with Synertia, they are going further up the value chain. And also for IXM and IXS, they are going to increase the share in those markets. And at the end, we are targeting a value above 80% in those focus markets. So in summary, what you see here is really the transformation of the company towards high volume and very profitable markets that we did achieve based on our traditional core competencies. So I think it was really a nice transformation that we have seen in the last 10 years, and that will continue. So what does that mean for profit and return? So how did this sales increase, how was that reflected in our profit and returns? If you look at the EBITDA margin, you see that from 2017, actually, the curve is getting steeper. Why that? That is basically driven by the increase of those markets, being semi and electronics, which have, by definition, the higher profits compared to the traditional markets. Now, while it is good to look at EBITDA margin, at the end of the day, what counts is that we are generating high and sustainable returns. Those we are focusing on the KPI ROCE, which is also part of the long-term incentive plan of our top management. And what you see here is that back in 2012, actually we did perform very badly, not even covering our cost of capital of 9%. And after that, started to increase to achieve in 2022 a value that is above the top quartile of our peer companies. And I think that was quite an impressive evolution when it comes to return. And our aim is to further increase that value, to further increase the ROCE. And with the target that we have set, we are convinced to generate high and sustainable returns. In fact, covering the cost of capital almost 4 times. Now, how is the divisional contribution related to those targets that we have seen? We have made, of course, a detailed bottom-up planning on one hand, compared that also with the overall market trends that are relevant for our company, and the outcome is what you see here. So when it comes to sales, the shares of the divisions in the top line actually will not change dramatically compared to 2022. That means, in other words, that the divisions are assumed to grow at a similar pace during this next period. When it comes to EBITDA and return, also there, basically, the picture is not going to change fundamentally compared to today. Of course, IXS, they are going, of course, to recover from their rather low values that they have. Sorry for the voice. For the rather low values that they had in 22, and with that also give a significant contribution to the overall increase. Now, while the presidents are going to talk in detail about the drivers that they have in their divisions to increase profit, what you see here on this waterfall chart is the consolidated view for the group. And let me start with the adjusted number of the year 2022. As you remember, we had quite a high cost related to the trial expenses in 22. If we are normalizing this, we start with 21.8. So that's the starting point of the margin increase. Thank you, Uli. So that's the starting point, and the main increase, of course, is volume-driven that is going to happen. And in that volume, of course, the main increase coming from PCT, having a share of 60–70% of the top line. As an addition to that, we are going to have this time in the next upturn, we are going to benefit from our facility in Malaysia in the full extent for matchbox production. So that will also yield an improvement compared to historical values. And in addition to that, in the divisions, the ongoing lean activities that they have will also further boost the EBITDA margin. On the other hand, as a tech company, we want to further invest in product development, basically to capitalize on all the opportunities, at least on some of those opportunities that Stefan just talked about and that the divisions are going to talk about. Next to that, and also that was mentioned, market development is key, right? So we want to be close to our customers because that is really key to bring our new developed products then into the market. And so all in all, what we can say is that yes, the increase in EBITDA margin looks challenging on one hand. On the other hand, based on the bottom-up plan that we did, we are feeling quite comfortable to really achieve those improvements that we have listed here. Now, coming to some further KPIs, which we do not explicitly guide for, but are an integral part of our financial model. So what we see here are our two main investment areas, actually. So it's CapEx and it is R&D, or in other words, our capital allocation. Let's start with CapEx. CapEx, we are anticipating a bit an elevated level compared to historical values. And that is driven by the fact that besides the recurring capacity enhancement and replacement spends that we are going to have. We are going to add the facility and the related equipment that we are going to need for Penang. So that will be a major area of spend in the next coming years. And that we need a new building is actually a very good news. I remember back in 2019 when we on one hand announced the divestment of eBeam and then had basically the building expansion in Flamatt. We were asked, what will be your capacity utilization of that building in 2025? And then we said, likely we are going to have still idle space. The fact that we are now going to build a building in Flamatt basically means that we are going to run out of space in Flamatt earlier than anticipated. So that's basically the good news. The other good story here is that we are adding for the first time substantial production capacity outside of Switzerland. And this is helping us also in rebalancing a bit our currency exposure. Another main investment area in the next coming years will be our ERP upgrade. And Stefan touched a bit related to the buzzword digital transformation, digital agenda. To achieve that, basically, a new ERP is the cornerstone of that. And we are convinced that we can really leverage there a lot of potential in further automizing all our back office processes that we have across all locations. You have to imagine that our current ERP we did introduce back in 2009-10. Stefan, we were part of that exercise, right? And that is still in place and does not have all these automation features that are now available. So with that move, we really believe to increase efficiency also in all back office areas. Let's now go to R&D. There, basically, we are committed to fund R&D at the same level as we did today, historically, in terms of ratio to sales. That is really our commitment. We are a technology company. That is basically our core, and that we want to keep. That means our product portfolio is going to continuously change, of course. And if we look at some statistics that we have done, we can say that within 5 years, roughly 50% of our top line is generated by new products. And I think this really shows our technological leadership in that field. Now, coming to some balance sheet KPIs, and before even talking about those, basically, let me say that right away, they are in a very good shape, really good shape. I mean, if you look at the equity ratio, we never went below 50%. And so that is signaling strength and solidity of the company. Next to that, cash, also that is at very good levels. And as you know, cash is the oxygen that you need to act in an independent way, regardless in which market situation you are. And also at very good level is the ratio net debt to EBITDA, very low, historically very low, and also going forward, we are going to keep that quite low. And now add to this our revolving credit facility that we have, and you can see that we have really ample access to cash. So to summarize here, we have a very strong balance sheet, implying a rather low risk profile. And this we want to keep going forward. Then some further relevant KPIs that are cash-related KPIs mainly. We also have a focus on those. They did reach in 2022, I would say, good levels, and they are going to recover as soon as the semi-upturn will kick in again. That's basically as an introductory statement. So net working capital ratio, we want to also, going forward, a target range of roughly 20%. I think we believe this is a good level to be at. Then capital employed, turnover, so basically half of the equation of the return on capital employed, of course. Here, considering the rather elevated CapEx spend that we are going to have in the next coming years, our minimum target is to be at the upper end of our historical values. That's our minimum target. Ideally, we would even in that phase be able to improve that, but our minimum target is really to be at the higher end of our historical levels that we had. And last but not least, or basically almost the most important one, free cash flow ratio measured in percentage of sales. There, based on our increasing sales volume, we are targeting a value that should be at least above 10%. So that's basically what we are targeting, and that is also allowing us, after having paid for third-party financing services, this is allowing us to keep a stable dividend payout ratio, which is for us very important. Which brings me to the very last KPIs. So at the end of the day, all what we have seen, at the end, it should be reflected in increasing dividends and increasing share price, right? So when it comes to dividend, we still want to target that range that we had historically and also made publicly available. That is basically what we want to keep going forward. And what you can see here is that historically we never went below that range. So that really shows a strong commitment to what we say. On the right-hand side, what you see there is basically economic profit. And while ROCE is good to look at, to compare with other companies in terms of benchmark, ultimately, the proxy to measure value creation in an absolute term is economic profit. And those, during our yearly strategic reviews, we always look at by how much are we going to increase economic profit in order to assess if our plan is appealing to the investor community. And my take on this is the following. Considering the sales growth that we are anticipating, that is going to further boost the economic profit. Those, we are convinced that this is an appealing plan, and I'm sure that you do appreciate this. With that, I come to the very last slide, and I summarize with one sentence. So we don't only have all ingredients in place, as you said, Stefan, we also have the right financials in place to execute on our strategy in any given market situation. And with that, I conclude my part, and I thank you very much for your interest in our company.